Hi there, I'm John Stevenson, the Guaranteed Retirement Guy. Today I want to answer the question, is living off of my interest in retirement actually possible? Well, of course it is. It just depends on how much interest you need and the amount of retirement assets that you have to produce that type of interest. And that interest could come from, maybe bonds, dividends, annuities. I sell annuities and I help people with guaranteed streams of income. But typically with an annuity, you'll get a much, much higher amount of withdrawal rate than what you'll get from interest. Because even right now, interest rates are pretty decent. They're paying between 4 and 5% right now with CDs, with MYGA, multi-year guaranteed annuities, which are pretty decent payouts. But what happens when the rates go back down? That's when it becomes a problem. So it really just depends on the amount of retirement assets that you have. That really, and of course, the type of income, the amount of income that you need to support your lifestyle. So if you got $1 million and you can get 3% interest, that's $30,000 a year. But you might need $100,000 a year just to, live comfortably. Well, in that case, you're going to need $3 million if you don't want to touch the principal. Okay. Now, if you're thinking, well, I want to run out of the principal at some point in the future, then that's when people start talking about withdrawal rate risk. They start talking about the 4% rule that was, really someone came up with it 30 years ago, but it's been debunked several times. And basically that rule means if I take 4% out every single year from my assets, then I'll never run out of money because I'm going to have a certain amount of return because the stock market averages this over this amount of time and I should be fine. In theory, yes, it works. But the problem is when that theory was produced, it was with different market conditions. And that was before the dot-com crash. And when you had a roller coaster of, the S&P 500, it went down hard, went up. And then during the housing, went down hard again, and then went up. And it didn't even hit the levels that it had it hit the levels before the dot-com crash, like twice before it finally broke through. So the problem was when people were taking out 4% out a year, and they were hoping that they would generate enough interest to pay for that. Problem was on the down years when things were going down and they still needed the same amount of income, they had to start raising their withdrawal rates at like 6, 7, 10%, 20% even. And the problem with that, of course, is it caused their accounts to deplete really, really fast. And a lot of them had to go back to work, come out of retirement. And then those who were thinking about retiring at that time had to delay their retirement another 10 years. My wife's uncle lost all of his money in the housing crash, okay? So he had to delay his retirement quite a few years just from that. And so if you're wanting some sort of guarantee as far as interest, then I would recommend looking at maybe a MYGA annuity, okay, multi-year guaranteed annuity. You can get those typically, intervals of 5, 7, 10 years where people will lock in a certain amount of interest. And right now, as of the recording of this video, it's around I'd say 5.1% guaranteed over 10 years. So that's not bad. It's a lot better than 2% that was being offered just a couple years ago. So the problem with that is, and I'm sure you realize this as well, is at the end of that 10 years, what do you do then, right? If you've got $1 million and you're taking 50,000 out a year, that's not too bad. But then what happens when interest rates are back down to 2%? That's the problem. Is now you're like, all right, I'm reducing my income to 20,000 a year. I still want 50 grand. So what happens? Well, you start taking out more than your money is earning. And that's when you start depleting your assets and your account. And then you're just hoping at that point, well, I hope it doesn't run out before I die. And if it does, I hope I'm dead. And that's not usually very healthy. That's not something that any of us really want. We don't want to plan our retirement assets around an impending death, right? Usually we just want to live as long as we can healthily. And if we can, then be able to have assets that will pay us as much income as possible. And so that's why I like annuities, especially lifetime income annuities. It's different than a MYGA contract because with lifetime income annuities, you can get a much higher withdrawal rate, usually anywhere between 5 and 8% or even more, depending on the carrier. And these are guaranteed for life. Now, the principal balance does not last. It usually runs out after like 15 years. But if you're doing it for income, does it really matter? If you put in 500 grand and it gives you $1.5 million over your lifetime, that's really what you're looking for, is you're looking for a contract of income, giving you that that guaranteed interest. Really, that's what it's doing. It's giving you a guaranteed rate of return that you can never outlive. So, and of course, if you die early in it, then it just gets refunded back to your beneficiaries. So that's what's nice about these contracts is if you set them up with the right company, you can get the highest payout. And if you're married, you can get the highest payout, not only for you, but your spouse's life as well. That way you don't have to sit here and say, all right, well, I got to find the best dividend paying stock, and then hopefully they'll pay me as much dividends as possible. And of course, if you get the higher rates of, where the dividends are like 6, 7, 8, 9%, then usually they're a little bit more riskier. And so it's not guaranteed. And you're only going to get paid for as long as they pay you. Then you got to find something else. So that's the issue with that, is it's not a set guaranteed amount that's guaranteed never to go down. You could do, something with maybe like Coca-Cola. They're known for having, one of the longest streaks of strong dividends. But again, it's not very high. They're a little bit above 3% right now. So it's not a huge amount. And if you're looking for much higher levels of income, an annuity will give you a lot more than what interest is paying you right now. So really, you just have to decide how you're going to do it. If you're going to live off of interest only, then you got to have a lot of assets to earn that interest, especially if you want some sort of guaranteed return. So if I was looking at something like from a CD or from a MYGA contract, even any of those, you still got to continue to renew it. Or if you're looking at treasury bills, that fluctuates as well. But really, it's just math. So depending on how much income you need, you just have to basically say, all right, well, I need $100,000 in income. What's the amount of assets that I need to get that? And usually it's in the millions to get that sort of income. Whereas with an annuity, those are contracts that you don't have to put as much money in to get the same amount or even more income. So anyways, if that makes sense, if you want to book a call and you're thinking, I would like to purchase an annuity or I want some information about one, then please book a call. There's a link below this video. It goes directly to my calendar and we'll talk, okay? Bring your questions. Be happy to answer them. Be happy to go over whatever plans that you have for the future. And I'll show you all of the annuity contracts. Okay? It doesn't matter to me what you get, but I want you to at least see what's available. And then at that point, you can decide for yourself if that's right for you, okay? Annuity contracts, that's what they are. They're a contract, and they're contractual guarantees. And that's why they're so valuable, is because when you're looking for contractual income, you're looking for peace of mind, that's what they give you. It's kind of like life insurance. Life insurance gives you peace of mind knowing that if you die early, your family's taken care of. Annuities, they're the opposite. They still give you the peace of mind, but now the peace of mind is you know that you'll never outlive your assets. That's the peace of mind. It's basically, I don't know how long I live, but if I live to 110, I sure want to make sure my income keeps coming in. Okay, I don't want to run out. And so that's what an annuity does. It protects you from outliving your legacy. Okay, so anyways, hope you enjoyed this video. If you did, hope you subscribe, hope you share it. If you got questions, I hope you comment below and I'll answer your questions. So anyways, happy to do so. Happy you're watching. And we'll see you in the next video.